Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Good evening, ladies and gentlemen. Welcome to our special show, Market Gurus, where we get you to meet some of the finest individuals with a very long history of creating supernormal wealth on the Lal Street. This is almost the last phase of February, and we have about a month and a half left for your tax saving instruments to be fully built up as far as this financial year is concerned, and therefore we'll be focusing on some good tax saving schemes over the next month and a half. And our special guest today is Mr. Rohit Singhania. He's the co-head of equities and the fund manager at DSP Mutual Fund. Namaste Rohit ji. What a pleasure to host you, sir, on Market Guru. And for the last 18 years, Rohit has been with DSP Mutual Fund. And over the last two and a half decades, Rohit has navigated the Lal Street across various other places such as HDFC Securities, Quantum Securities, as also Smith Securities. Rohit, a very warm welcome to you. Good afternoon. How would you look at sentiment on the Lal Street these days?
So we talk about sentiments. I think everyone seems to be very, very bullish. And the reason for that is, if you see last 2 years in terms of the indices performances, most of the stock performances, we have almost seen a one-way up move, right? We haven't had that bout of correction. So I think as an investor, the sentiment no doubt is bullish or positive. But when I say that, I would like to add few things to it, right? Everything has a reason for it, whether it's good or bad. So for everyone, and specifically investors, it's very important for them to understand the reason why and how much of the reason for this can continue also, right, going forward. So when I look at India and when I see last at least 1.5, 2 years performance, right, in terms of broader indices, what is startling is, we have had a supportive macro. Our growth story seems to be much secular than our peers abroad. With the current political scenario, the expectation is the policies will continue even in the next leg of political gamut. And we have also seen, we talk about financialization of savings since last 10, 15 years back. But actually that's happened in the last 3 or 4 years, where individual investors in India have moved out from traditional real estate and gold and looked at equity as an investing class, may it be through mutual funds or even directly. So when I look at these aspects from a top down, I think they are one of the drivers. Secondly, if you look at it, corporates, right? When you talk about corporate balance sheets, today in India, the interest rates are high. But as in corporate, we are not worried. As an investor, I'm not worried about the companies I'm invested in. What we as Indian companies have done is, we have really cut down our debt over the last 3 or 4 years. We have become very smart in terms of how much leverage we want to take, how much interest costs we are paying today. So what's happened is today also, when we discuss with individuals or do media interviews, right, one common topic is interest rates. But today, interest rates per se are really not impacting corporate so much because of deleveraging, having a better credit profile. So I think this, when I added to the macros which I mentioned earlier, has been the driver. And I feel that should continue for some point of time at least.
Okay. So, Rohit, with that background in mind, let's now look at the tax saving fund that you have been so wonderfully running over the last 5 + 4, 9 years. We are discussing DSP Tax Saver Fund as of now. About 13,418 crores is what the asset under managements are. And when you look at the returns since inception, the fund was launched in 2007 of January. Each year, the fund has appreciated about 15.34%. That's a fantastic CAGR. And in terms of peer returns, it's in the upper quartile of fantastic performers. Rohit, let's just discuss tax saving in particular, because the government of India gives you this wonderful option to get an offset in tax and create wealth at the same time. So if you could just describe this in a couple of sentences, then we'll drill down into your fund.
I think when you look at Indians, right, whether we have corporates or we are individuals, we all want to save tax, however we can. I think this is one of the best ways where, the government allows you to put in about 1.5 lakh rupees every year and you save tax on that. Historically, if you see the returns from the ELSS category of schemes compared to other tax saving instruments, the ELSS has generated much superior returns and the compounding has also been higher. So it solves two purposes. One, as an individual investor, you get the flavor of equity, you understand what equity is. And since it's a 3-year closed-ended product, you don't get swayed as an investor by cycles, by short-term moves. So you have the habit, inculcating the habit of being long-term investor. I think, yes, it saves your tax, makes you be in the market for longer term and play the entire gamut of the cycle.
Okay, so this is something to be noted while we are discussing the tax part of savings. Remember, every tax saving fund has a lock-in of 3 years, and should you put in an SIP as well, that also works on a rolling basis, that the first SIP that becomes active can be encashed in the 37th month. So that's the only drawback, and this is not actually a drawback because it allows you to sort of spend time with the scheme. It allows the fund manager to have the flexibility of a lock-in and then invest accordingly. It's, according to me, one of the best features that allows investors to undergo the cycle process of investing and at the same time make a lot of money. I'll just share another detail in terms of the SIP returns that DSP Tax Saver Fund has given over time. And if you had invested a sum of 10,000 rupees over the last 17 years of existence of this fund, each month you would have incurred a cost of 20 lakhs 40,000 rupees, and ladies and gentlemen, the return would have been 1 crore rupees at an annualized pace of 16.7% per year. That's the kind of wealth that Indian equities have been creating regularly, and this is something that you should also look into. Now, Rohit, let's get into the nitty-gritties. When I look at your portfolio, you are intensely overweight in the financial space, and if you look at how the peer group has invested, it has an exposure of about 23%, 25% as the category average into financials, and you have an average of about 33%, which is fairly substantial. And the top 3 holdings are HDFC Bank, ICICI Bank and SBI. You've also taken this opportunity in the market to add to your private sector holdings. Could you just explain the logic?
So when you look at sectoral exposure, right, there are 2 or 3 things which go into it. One is relatively how are you seeing the sector. So when I'm financials overweight, it automatically means among the various sectors available to us today, consumer staples, IT, healthcare, auto, I feel banking gives me the most comfort, both in terms of business outlook and 2 also in terms of valuations. So when you talk about sectors or stocks in it, right, everyone wants to buy good businesses. I mean, no fund manager will tell you want to buy a bad business. You want to buy good businesses, and you want to buy businesses where today maybe it's not that great, but over the next 1, 2, 3 years, it can, better off. So at what price are you buying the business? The price is important. So a company may be good, a business may be good all the time, but the price may not be good at all the times. So when the approach goes in terms of sector or stock selection, that's the basic approach. So financials, right? I like the valuations today. They have great and stronger balance sheets and growth profile also for the next long run. I think the confidence is there. That's what it's showing in the portfolio as you see it today.
Absolutely. Rohit has taken this opportunity for the slip that you've seen in HDFC Bank over the last 2 or 3 odd months to add into his particular holding. I'm sure he will not comment individually on the stock, but the sectoral, how should I say, allocation has gone up over the last 1-2 odd months. And this brings to me a very controversial question, Rohit. When I look at your portfolio, you've taken this opportunity that the rally that is happening in PSU stocks to lighten your holdings. Let me just mention a couple of stocks where Rohit has used the rally to trim his holdings. NTPC in particular, Power Finance Corporation is there, as also Gas Authority, BPCL and HPCL. These are the top 5 PSU holdings in his top 20 portfolio, and Rohit has very smartly used this rally to trim his positions. Rohit, time will only tell whether these stocks will rise much further from here on out, but what was the logic to trim?
So again, when we're talking about PSU stocks, right? So again, they are into a PSU category, but again, the names which you mentioned are individual businesses, right? They have a value. How does the value get ascribed into the stock prices? If one, you get confidence on how the business is governed, you get confidence at the end how the business can pan out over the next few years. That's how you get confidence, right? So as I mentioned to you earlier, good business, bad business, and then what price are you paying? So maybe these businesses were always good businesses, right? But the lens as investors or past, actions from promoter owners gave you less comfort. So I think we were slightly, I mean, it's on hindsight, we were slightly early in the PSU trade, and not I would say PSU, but in businesses, right? Which businesses of the PSU could do well, where we were seeing turning points. Today also, if you look at the portfolio, we have a significant exposure to PSUs. So the cutting whichever has happened is very marginal. So we still feel these businesses are strong, and today also they form a significant part of my portfolio.
Wonderful. And why not book profit? Of course, that's the reason why net asset values go up. And trimming of profit and of course of holdings is very necessary. That doesn't prevent Rohit from adding to these positions. And I'm really glad that these are long-term positions. Therefore, it essentially means that Rohit has made supernormal profit on his PSU holdings, and at the same time use the opportunity in financials where there's a lot of dip in prices to shift that money. Whether that may have happened or not, but that seems to be the most probable case when you look at his portfolio. The other thing that catches my attention in your portfolio is this insistence on extreme quality when it comes to the top 10-12 stocks. As also the sideways trend that we are witnessing in frontline IT. Rohit, how do you see this sector? We've seen IT being a laggard over the last 2 odd years. How do you see this in the light that probably towards the year end we'll see the Federal Reserve cutting rates, and that's supposedly going to be beneficial to domestic IT companies? Is that the thread that's running inside you as well?
So Shailendra, to your first point about quality you mentioned. So in my head, I don't bucket companies into quality and growth. The market talks about it. You have to use the balance. They're doing good. It's performing well. People call it quality. If business is not doing good, value, it becomes value, right? So that definition keeps on changing. So my focus is, if I see business growth coming or delta and growth or ROE coming, I want to own those businesses. Yes, sometimes I have to categorize them because the market categorizes value or growth, but I don't see it that way. Coming to IT, as I say, I think IT has been a peculiar case. If I think that's the only sector, if I see last 1 year, and the reported earnings for most of the companies, right? Every quarter you have seen earnings being downgraded. So this is the only sector where the stock price is moving in one direction and the earnings are moving in other. The whole thought behind this is at some point of time, whatever pressure maybe the banking and the financial services segment has seen in Europe and US because of the slowdown, higher rates over there. At some point, if this reverses, they will come back to the market. They will increase their budget spends. Two, if you inherently look at IT names, right, across, whether it's small cap, mid cap, large cap, I mean, debt, they don't have any debt, right? They're net cash companies. Their cash flow to their cash conversions relative to EBITDA and PAT is very high. They are good dividend paying companies, so you have a base dividend yield. I think right now it's that cash factor, quality of balance sheet, dividend yield, and cash flow yield, what you're trading at. That is, I would say, one of the investment reasons. And two, at some point of time, if rates reverse, I mean, history tells us that this could be one of the sectors where you could have the business performance coming back.
Okay, so with that in mind, the other broader theme, Rohit, that's running in the market is this interest rate cut theme across the domestic universe, which is the best way that to see that getting reflected is in the auto space. You have some fantastic names, and overall, if you see, DSP Tax Saver Fund is also overweight compared with the category average. About 8.3% of your assets under management are in the automobile space compared with just 7%, which is the peer average. How are you looking at auto stocks at this present moment? Both January and February have seen smashing records from Mahindra and Mahindra, Maruti, the Bajaj and two-wheeler pack. Tata Motors, of course, has been an outperformer all of 2023. How does auto look to you now?
So to start with, being positive on auto is not backed by expectation of interest rates cut.
Okay.
Right. So I'm not an economist or a guru, but for me, interest rates expectation is at least till September this year are going to remain where they are. So if at all, if there is any cut, it should be maybe in the fourth quarter of this calendar year. The thesis in auto is, if you go back 5-7 years, the kind of volumes the auto industry was doing, and where were we in the last 2 or 3 years? Where has the income level gone up? And what can be the potential for overall auto volumes? That's one. Two, then you have to drill down. Like auto today, when you talk about auto, like you rightly mentioned, right? There are passenger cars. In passenger cars, there are entry-level cars, SUV cars, high-end cars. Then there is two-wheelers. Two-wheelers, you have again a whole gamut from entry-level to high-end. Then you have commercial vehicles ranging from heavy trucks, ultra-heavy trucks to a three-wheeler. So when you look at autos, it sounds one name, but how we look at it is we have to divide it into various categories and then see what are the category drivers and try to, buy stocks accordingly. Like you mentioned UVs, right? Utility vehicles. So if you look at it last 4 or 5 years, this segment in India has really picked up, right? Everyone wants to buy a UV. Till 5 years back, UV was not that great. Maybe we never had so many products in the country, or you want to have that feel-good factor, right? So in every segment of auto also, you need to analyze what the consumer preference is turning or changing into, and then try to put that into stocks. Give it stocks have got higher proportion of exposure to that particular category.
Okay. So, Rohit, let's just draw our attention away to what has been and to where markets or sectors could possibly be. The fresh inflows that are coming in into DSP Tax Saver Fund, how are you deploying them? Is it a sector-specific call, or are you drilling down in terms of mid-caps and small caps into individual preferences where probably third quarter earnings have shown some uptick?
See, usually if you see the past history also of a ELSS fund, I don't take big cash calls, right? So whenever you get inflows, it's like, since you're already running a live fund, right? So you have your stocks, you have your sizing, and what active weight you have is the benchmark, right? So, I mean, you know which stocks to add at a given point of time if you have cash, right? So, I mean, so whatever the best ideas we feel at that point of time and what cash levels I'm comfortable with. It could be a case maybe I may keep the cash for next week, 10 days, right? I mean, I don't need to invest it today. because the fund is already invested, you're already benefiting out of it, right? So yes, the new investments come in the ideas which I feel at any point of time are best placed. Because see, in the end, if you own stocks, it's there in your mind. All the
Yes.
60, 70 stocks are not going to do good together, right?
Yes.
You know some stocks are near term, medium term, long term performers, and that's how you to try to size them also. So again, the new inflows are also put in the same way as the old inflows were there. At a given time, where are you seeing the baskets of where your fund is positioned today and where you want to add it?
Okay, but Rohit, let me just ask this question differently. Over the last 4 odd months, when the rally has gone in particularly parabolic space from say November, December, and January, have you added any new stocks to your portfolio, or are you
Yes.
only adding to fresh positions,
No,
existing positions?
there are a few stocks added to my portfolio over the last couple of months. But again, they were like there were one into telecom. If you look at a fact sheet, in fact, most of the additions were done in financials. You
Okay.
know, so I
These
mean
are
I would
new
say
additions that you mentioned, or you're talking
no.
about adding
So
to
in
existing
financials also, if
quality?
you see last 5 months, there were one new addition.
Okay.
In telecom, there is one new addition. So again, that addition again, it's not that I want to add in telecom.
Okay.
If I find a business which I feel it's doing good or can turn around and it's available to me at the right price, then it
Okay.
may be in telecom, it may be in IT also. It will not make a difference to me, because it's a business which I am buying. It happens
Fair
to be
point.
in telecom now. Yeah.
Okay, so in this kind of an environment where almost all stocks that are sensibly valued are at record highs, how difficult is it for you to find a new gem for your portfolio? And what are the 2 or 3 things that you're looking at when you narrow down a stock and then ultimately buy it?
Right. So I think the starting point is, the whole research process is, you want to buy, as I mentioned, good companies or companies which can show improvement in business performance, right? On the overlay on that is at what price are you paying for it, right? So as DSP, we have a nice number of research analysts. We cover about 350 odd stocks, and we try to categorize them into various baskets. Then as a fund manager, is my prerogative. Like I said, I don't like overpaying for businesses, right? So when I speak to my analyst, we sit down sector wise, which are the good businesses where it's available at a decent price and they are not overpaying for it. So that becomes the basket for me. From there, in terms of expected delta and earnings, what kind of upside do you see in the price over the next 12 months, 18 months, 24 months? Then that becomes, you come down to maybe 10, 12 stocks. Out of them, you try to categorize into segments, sectors, and then you build a portfolio. I think that's in a nutshell, that's how it works. You have a funnel, you get it down to smaller ones. But yes, margin of safety in terms of what price are you paying, that is very important for me.
Okay. And Rohit, just the last couple of questions. I'm just requesting you to look at your crystal ball and tell us where do you see the markets about 18 months to 2 years from now. For a fund manager, that's easier to do because you have a medium to long term investment horizon. So the Nifty from 2 years hence.
I think that's the most difficult question for any fund manager to answer, right? So since you asked me to crystal ball gaze, it's easy for give me a number, right? So when you look at say a market like Nifty 50, or when you look at a stock, you look at the earnings for next 2 years, and potentially at what kind of multiples maybe it could trade at 1 year, 2 years down the line, correct? So I mean, yesterday itself, I was looking at Bloomberg, right? The consensus earnings for Nifty for the next 12 months and next 24 months. I think based on that number, I think we had around 1200 Nifty EPS 24 months down the line. And if you give a 20 multiple, and yes, I understand that it's an elevated multiple, right? Because when
Yes.
you look at long-term bands, it's from 15 and a half to 18-20.
Yes.
So we are slightly on a higher side, right? So I think that 18 to 20 multiple is a fair multiple in Indian markets today. Looking at the kind of growth we are having, the stability of macro and political. So I think that 18 to 20 multiple, I think is a justified multiple. So you can
Okay.
multiply that 1200 into 18 to 20. That's anything between 23,000 to 24,000 could be a possibility. If you give me a crystal ball, I would say that.
Okay, chalo. This is a fairly decent and how should I say modest target, and I'm sure the markets are looking forward to achieve that. Rohit, and my final question: are mid caps and small caps overheated?
Some segments, yes, but not all. So I would not generalize the category. But when I see, again, for me, as I mentioned, earnings growth is the driver, right? So segments where you're seeing earnings growth, I think I don't feel the valuations are overheated. But yes, there is a significant part in that space, which when I see the stock price today, it makes me believe, what am I missing or what am I not understanding the business fundamentals. But I would not put it as a basket, right? So when you look at, say, Nifty 150 index, all the 150 stocks don't worry me.
Okay, so I think we've lost a touch with Rohit. Let's try and get him back. But he says two very sensible things, that the markets don't look to be overheated at that point of time on the large cap space. You should be looking at something like 23,000, 24,000 on the Nifty in the medium term. Rohit is back. So, Rohit, you were giving your understanding of what parts of the market are overheated.
Yeah. So as I mentioned, yes, if you look at the index levels for small cap, mid cap, they seem to be trading at much higher multiples than their past. But again, when you drill down to stock wise, right? Because as a fund manager, as an investor, that's your job. So I think there are still pockets where the business growth or business fundamentals are justifying. So yes, overall they look expensive, but all the 150 stocks out of the, it's not expensive. There is business back behind it. So I think better to go bottom up.
Okay, wonderful, Rohit. It's been such a wonderful 25, 27 minutes speaking to you on how the portfolio of DSP Tax ELSS fund has been constructed, and what goes behind the thought process of a fund manager when he looks at markets on a regular basis. Thank you so much for your time, and here's hoping you get higher and higher ELSS allocations each year. At the moment, you are touching about 13,000 crore rupees. Next time we meet, let's look at 15 or 20,000.
Thank you. Thank you for your wishes. Thank you all.
Okay, ladies and gentlemen, that was Mr. Rohit Singhania. He's the co-head of equities at DSP Mutual Fund and runs the DSP Tax ELSS Saver Fund. Thank you so much for your time. And remember, this is the time to sort of look into your tax saving allocations when it comes to filing your returns. In an ideal scenario, you should be having a monthly SIP in a tax saving fund so as to not to do bulk purchases, but 99% of the people don't do that. Please use this opportunity over the next 1.5 months to do an aggressive SIP if you haven't already in a sensible tax saving fund, and among them is the DSP Tax Saver Fund. Thank you so much for watching us. Remain glued to Business Today for all your news needs on the financial side. Have a nice evening.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe for multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.